Inflation is increasing, and in this video we're going to look at the drivers behind that acceleration, but also why many people think it's going to be transient, with a peak in inflation roughly around the summer of 2021. Now, if you do want to hedge against inflation, it's also important to understand what's already priced into markets with break-evens. So we'll also look at those. Now, if you do want to learn more about investing, a great way to do that is by signing up for our free weekly market roundup. You'll find a link to that in the description below me and beside me. So let's look at what's happening to inflation in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start off by looking at the latest inflation numbers. But before we begin, let's be really clear about the difference between a price level and a rate of increase. So a price level would be how much you pay for a tank full of gasoline, for example, whereas the rate of gasoline inflation would be the percentage by which that price has increased or decreased over the previous 12 months. So what you can see beneath me here are two measures of inflation in the United States. Now these are based on two different surveys and they use a slightly different basket of consumption to estimate the rate at which prices are increasing. The red line is called CPI, or Consumer Price Inflation. And you can see that that's increasing at a slightly higher rate than the blue line, which is personal consumption expenditures. Now, the Federal Reserve will look at many different inflation measures, but the one it focuses on usually is PCE inflation. So will we. Now, normally we never talk about the level of inflation. We only ever talk about the rate of inflation, which is the gradient of this graph. When it's steeper, as it was here in the late 1970s, that means the rate of inflation is higher. And when it's flatter, as it has been recently, that means the rate of inflation is lower. So now let's switch to a graph in which we look at the rate of change of the graphs below me. So here's the rate of change of those two inflation measures going back to 1960. And again, you can see that the red line is usually above the blue line because CPI inflation is usually greater than PCE inflation. Now these huge spikes next to me are the Volcker era, when inflation really did get out of control. And I think very few people now remember what it was like when inflation was above 10%. The dashed red line underneath me is the Fed's target for inflation, which is 2%. And we're used to the Fed being in control. It's hard to even imagine a situation in which inflation does get back out of control. But if you look at the March number for CPI inflation, you can see that it's spiked quite a bit. And that certainly got some people worried. Now, a big part of that increase was due to gasoline prices increasing very sharply. It's certainly not true that all of the elements of the consumption basket increased equally. But this is just the beginning of a larger spike in inflation, which everyone is expecting. So next, we're going to go through the reasons for that spike. Now, the first of those three reasons is called the base effect. If we switch back to price levels, you can see these three successive months from March to May 2020 when prices were depressed, and that was due to lack of demand as people were locked down. And if we change that softening in prices into a year-on-year change, you can see that it resulted in a deceleration of inflation. The rate of inflation decreased, such that it fell from its typical 2% at the beginning of 2020 to just a shade above zero. So in April and May, inflation was roughly 0.5%. And beside me here, you can see that rise in inflation, CPI inflation, to above 2.6%. And that's higher than it's been for some time. Now, part of the reason why that March number was high was that it was compared with March in 2020, which is when prices were just starting to go lower due to the pandemic. So next, we're going to look at what could happen to inflation if we make a really simple assumption. So again, this top panel is the PCE price index. And of course, that's a level, not a year-on-year change. And the panel underneath is the year-on-year change on that price index. So our really simple assumption is that the rate of inflation goes back to 2% from March onwards, and it stays there forever. So that's why this extrapolated red line is simply increasing at a constant rate. So this January inflation number that you can see here above me was based on the rate of change between this point in January 2020 and this point in January 2021. And the February number was also not really affected by the pandemic But then in March, the year-on-year comparison is starting to draw in that weaker data in March 2020. Compared to that low level of prices, the rate of change is now looking quite big. And in April, we should see an even bigger effect. Now the annual change will be more like 2.7%. And in fact, that elevated level of inflation would remain for 2 successive months, because there'd be 2 successive months in which that base effect of weak prices in 2020 would have a significant impact. But then that effect will start to diminish as we go into data in June. Now you might expect that if we've had a big fiscal stimulus, then we should see an increase in inflation as a result. And that's perfectly reasonable. Now fortunately, I don't have to do that because Claudia Saarm's already done it. So she's come up with a forecast, and in this shaded region beside me, you can see what her forecast for inflation is. Now, if you remember, with our really simple assumption and straight base effects, we thought inflation would go to about 2.7%. But when Claudia factors in the fiscal stimulus, she thinks it would peak at around 3.3%. And that would occur in May 2021, and then inflation would gradually subside after that May peak. And Claudia's second point is also really interesting, which is that the Fed's target is now an inflation average rate. The whole point of that was that it would iron out these transient spikes in inflation and stop the Fed hiking prematurely and causing a recession. So the dark blue line that you can see here is the average inflation over that period since January 2020. And what's interesting is that that average rate of inflation never exceeds the Fed's threshold for tightening interest rates. So if we do see a transient increase in inflation, such as this one, then the Fed almost certainly will not increase interest rates. The second factor which could increase inflation would be supply chain disruption. So let's say we've got a factory that generates electricity. One of the inputs to that business and one of its costs would be the fuel used to generate the energy. So if the pandemic has somehow reduced the supply of that fuel, then it would create a transient or short-term shortage in that fuel. But the demand for the fuel would still be there. And that means that the price of the fuel would increase over the short term. Now that means the business's costs would increase, and it may choose to pass on those higher costs to its customers in the form of an increased service cost. Now that's called cost push inflation, and the key thing to understand about it is that it would be transient. Eventually the lack of supply would be sorted out as the pandemic ebbs, and prices would go back to normal. And there's a nice real-world example of that, which is the price of lumber. So this top index is part of the PPI inflation, which is producer price inflation, and that measures the costs of inputs to various industries. And for the house construction industry in the United States, softwood lumber is one of the inputs to that business. And the price index has increased very sharply since March 2020. And in this bottom panel, you can see the percentage year-on-year increase, and that's been above 70% year-on-year. So that's made constructing houses in the US much more expensive. And as this story in the FT points out, that was a direct result of the pandemic. But it was actually because lumber mills misjudged the effect of the pandemic, and they actually reduced production in expectation that demand would plunge. Quite a reasonable assumption. But in fact what happened, as we now know, is that US home building went through something of a renaissance. And as a consequence there was a surge in demand for lumber, which the mills simply couldn't supply. So what they chose to do instead was to increase prices. It's not the case that lumber prices will carry on increasing at 60% or 70% a year forever. What we'd expect is that eventually sawmills will hire more people and those prices will subside again. Another example that's been discussed a lot recently is the shortage in chips. Now, the US typically depended on Asia to supply those chips, usually from Taiwan, but in this interview on CNBC, the CEO of Intel, who's Pat Gelsinger, discusses how his company is going to try and fill that chip gap. So it may require the creation of new supplies, maybe even domestically oriented supplies in America, but it's certainly not going to be the case that we have a permanent chip shortage. So in summary, cost push inflation is likely to be transient. The third factor we'll consider which could push up inflation is pent up demand. Here's a tweet from Matthew Thompson, who's in central London recently, and he's tweeted a picture of people having a great time as they're finally let out into bars and restaurants. He describes a situation where there's spontaneous cheering, and from experience, that's pretty rare in London. In fact, it sounds a little bit like the celebrations after World War II on VE Day. And the argument goes something like this. Vaccinations have been rolled out very successfully in many countries, including the UK, and that means that many of us are now able to venture back out into public and the lockdowns can ease. During the pandemic, we've saved a lot of money, which we can now spend, and in some countries, people have actually received relief payments. In the US, lots of people have received stimmy checks, for example. And that combination of factors will create greater demand for things like restaurants. And this would be called demand pull inflation. And as Jay Powell said in March 2021, as the economy reopens, people will start spending more. However, you can only go out to dinner once per night. So even though there will be pent-up demand for things like restaurants and nightclubs, eventually things will return to normal behavior. People might go slightly up market, going for higher quality goods and services, but even for things like holidays, you can only go on a certain number of holidays every year, and you can certainly only go on one holiday at a time. So just as with the other factors, it's very likely that pent-up demand will be a transient effect. Now let's look at what the Federal Reserve actually said in its Summary of Economic Projections in March. So this is called the Summary of Economic Projections, or the SEP, and it's published in a document alongside all the other Fed materials. Now the Fed always stresses that this is not a forecast, but what it does do is it shows you the expectations of the committee members about what's going to happen to inflation, growth, and unemployment. So the x-axis on this graph is the expectations of what's going to happen to inflation in 2021. The lowest expectation here on the left is 0.9%, and the highest inflation expectation is 2.6% on the right. And the y-axis on the graph is the number of committee participants who thought that it would be in a specific range. Now the dashed line underneath me is what the committee expected in December, and that was very much centered around the 1.7 to 1.8 range, which is fairly low in terms of inflation expectations. But what's pretty clear is that in December they upgraded their expectations of what would happen to inflation. Now that's because the vaccinations were being rolled out more quickly than expected, and the economic data started to improve a lot. And you can see that 11 members of the committee expect inflation will be around 2.3 to 2.4% at the end of 2021. But look what happens in 2022. The expectations snap back to 2%. So what the Fed's expecting is that that spike in inflation will be short-lived. Now there's not unanimous agreement about that. So 2 members expected that inflation would be 2.3 to 2.4% at the end of 2022, and 4 members thought that it would be a little bit lower, at 1.7 to 1.8%. Then by 2023, the committee expects that inflation will start to rise again, presumably as growth starts to improve. And they also produce a forecast for longer run inflation where, unsurprisingly, they think that inflation will be at the target which they set. Now, if you are thinking about hedging inflation, it's critical to understand what's already priced in to inflation markets. And to understand that, we have to look at break-even inflation. What is that? Well, it's a difference between, say, a 10-year inflation-protected bond and a 10-year not inflation-protected bond or regular nominal bond. But what's critical is that they're both issued by the US Treasury, and you have to compare maturities which are comparable. So 10-year with 10-year or 5-year with 5-year. Another way of understanding that is that they represent the market expectation about the path of inflation. This top panel is break-even inflation over a 5-year period, and the bottom panel is over a 10-year period. And as usual, I've shown the 2% Fed target here as a dashed red line. Now, the only real hedge against inflation is one of these inflation-protected bonds, and that'll only be better than a normal treasury if inflation on average over that 5-year period exceeds the break-even. So if inflation is above 2.5% over the next 5 years, you'd have been better off buying one of these tips, which is inflation protected. If inflation is below that 2.5%, then you'd have been better off with a normal government bond. So before you rush out and buy tips, just consider whether your expectation of inflation over the next 5 or 10 years is greater than that break even. If it's not, then it's probably not worthwhile, because that's already been baked into the price of those bonds. And if we look at the 10-year break even, it's slightly lower, it's below 2.5%. Another one of the Fed's favourite inflation measures, which is market-based, is the 5-year inflation, which looks at the 5-year rate of inflation taken 5 years in the future. And there you can see market expectations are fairly well anchored around the Fed's 2% target. There's a nice blog from the Council of Economic Advisors, which they've also turned into a thread on Twitter. And one of the graphs that they share in that is a combination of multiple measures of inflation expectations. There are 22 different measures that go into this estimate, including the ones that we just saw. But again, you could see that expectations, although they're rising, are still fairly well anchored at that 2% level. So if you are thinking about buying inflation protection, just keep an eye on those break-evens. They tell you the threshold that makes it worthwhile. And personally, I think they're fairly punchy target. I don't think that we're going to see a sustained increase in inflation well above 2% for the reasons I've outlined. But this is the kind of topic that we discuss all the time in our Patreon community. And you can actually vote as a member of that community on the explainers which I make, which is only available to members. So you can also join us on Slack and ask questions of me and other members of the community. And there's quite a lively debate about all matters investing. If you do want to learn more about that, it's really easy. Just click on the link in the description below me and beside me. And as always, thank you for listening.